Hello traders and investors, Will back here with another one, coming to you with a Friday market and weekly market recap video. Hopefully you guys had a decent week in the markets last week, and hopefully you're having a very nice weekend as well. In terms of the action on the Friday session, it was a very wild day. We started off the day, the SPY was down 1% and the Qs were down 1.8%. And then midway through the morning, we had a very large reversal. Now the reversal is due to two things. Number one, we finally came in and touched the 50-day EMA on the S&P, which we were talking about on the channel. That is also a confluence with the 12 EMA on the weekly. We haven't really tested these major moving averages in the last 4, 5, 6 months, and we were saying that the markets were fairly extended as we continued to battle between the short-term bearish narratives that we described on the channel and the long-term bullish tailwinds as well. Take a screenshot of these if you need to. Now, that was a bit of a technical bounce for the markets, and it played out fairly well. But at the same time, there was also some rumors that the Senate would be meeting over the course of the weekend to possibly end the government shutdown. Now, at the time I'm filming this video, unfortunately, that hasn't happened just yet. The Saturday meeting is now concluded. They will be convening again on the Sunday session, but still, as of right now, the government does remain shut down. So, is the sell-off that we've been seeing in the past week and a half finally over with this very nice bounce? Or could we possibly just get maybe a dead cat bounce and roll over? We'll be talking a lot about that in today's video. Speaking about today's video, we'll do a few key things together. Number one, I have 3 earnings presentations for you guys. We'll be going over Axon, which had their earnings on the Tuesday session. Then we'll be taking a look at AppLovin, which had their earnings on the Wednesday session. And finally, we'll wrap it up with IREN Energy, a fan favorite, retail favorite name that's been making waves recently, especially in light of their big Microsoft deal that they got just about a week ago at this time. So shout out to all the other companies that reported last week. Maybe we'll be able to catch up on a few more that I missed into next week, because next week is kind of soft. You'll notice here that we do have a big one, CoreWeave, Rocket Lab on the Monday session. Tuesday, you got Nebius, another retail fan favorite, and some other smaller names throughout the week that we'll cover a few of them, but in the event that we have to backtrack and cover some of the larger names from last week, I'm not opposed to doing that as well. So for today, Axon, AppLovin, and IREN Energy. Moving on further into the second part of the video, we'll be looking at our technical analysis, because now it matters a lot. We've touched a few of the substantial moving averages. Market breadth is improving, and as a result, we'll try to derive where the markets can possibly go in the short term and check on the rotation between the market sectors. After that, we'll take a look at our big tech list named down here and see whether some of these companies are in decent levels for some swing trades and or long-term portfolio positions. Thereafter, we'll take a look at our biggest gainers and losers of the day, of which on the Friday section, there were many. Several of these names were far more red than this leading into the early morning hours, but then we had some nice reversal. So we'll cover some of these names that are in the red right now, derive if any of them are in good swing trade opportunity locations, and the same thing for some of the names that had a beautiful green day as well. At the very end of the video, guys, I'll be doing a very quick portfolio recap, showing you guys some of the trades that we made last week. Here are all the trades that we've made together in our Discord, and I'll show you guys which positions I'm currently holding into next week as well, as I did deploy some decent capital on the Thursday and Friday sessions. You might remember me saying I was going to be very patient leading into the early stages of the week, but if the declines continued and hit some short-term oversold conditions, which they did, I would be participating towards the end of the week. So looking forward to showing you guys some of the new positions that I have. And that's going to be it for today, so let's jump right into it, shall we? The S&P on the Friday session went from 1% down to 0.10 positive, and the Qs down 1.8, swinging to minus 0.32. Now, all throughout the morning, we did have some pretty good market breadth, and that breadth actually improved throughout the day. This was actually one of the better days of market breadth that we've seen in over a week and a half, and market breadth, if this continues into Monday, seems to be curling around and might have met its local bottom. Take a look. Most of the damage was done by some of the big tech names, and semiconductors still a little bit soft across the board. Financials, really nice day on financials, and finally a more broad day in financials as some of your minor sectors such as asset management, insurance, and other players started to finally participate. Healthcare, also a fairly broad day. Finally, Eli Lilly was not lifting the entire sector on its shoulders. It was more broad-based. And the bottom half of the market having one of their best days in the last 1.5 weeks. So that definitely helped to improve some of the market breadth. If you take a look at the heat map, or if you take a look at the one-day relative, you'll see that even better, to where most segments of the market were indeed higher. The only ones down, technology and communication services. Communication services was largely kind of let down, unfortunately, by Google's 2% decline, as they are the largest weight in that segment of the market. On the 1 week relative, you'll notice some performance improvements. In relation to when we did this video on Thursday, all of the market segments were red on Thursday when we did this. Now, finally, with a nice end to the week and a nice bounce and broad market rotation, we finally have half of the market in the green and the other half in the red. To the downside, we do have technology as the worst performer of the week, as we do still have several major tech names in consolidation phases right now, and even some of the major semiconductor players coming down well off their highs. So before we get into more technical analysis, guys, let us dive into earnings right away. And we're going to start off with a very fun company, which is going to be AppLovin. So if you guys don't know what AppLovin does essentially, they are a fantastic company that has 8% of the market share of mobile ads. They almost control the entire market share of gaming advertising specifically, but they are a very large player in terms of mobile ads, and the company has phenomenal margins. Now, the company used to be broken up into two different parts. Number one was their advertising division, and the other one was called their suite of apps. That's why they were called AppLovin. So they held in-house a number of apps, over 200 to be specific, but they sold off that division of the business very recently, as it was the segment of the business that did not have the highest margins. So they sold it off recently, got almost $1 billion for that sale, and now they only have their advertising business, which is a very high margin business. So in terms of their earnings that they just reported last week, phenomenal earnings by AppLovin, nothing bad to say. 2.9% beat on EPS and a nice 4.68% beat on revenue. Now, in terms of further numbers for this company, their guidance was also very good. Revenue beating the estimates here of 1.55. We're going to come in at 1.57 and 1.6. And adjusted EBITDA margins did come in slightly in line. But the biggest thing here, guys, was the increase in net income. Look at this massive number, up 92% year over year. AppLovin is turning into a net margin powerhouse, 59.5% Q3 net margins, which is absolutely insane. If you notice this little chart here to my left or to my right, depending on how you're looking at this video, you'll see they've improved from a company that was making just last year, right, in 2024, about 25 to 35% margins. And this entire year, they've been creeping up higher and higher and higher, culminating in high 50s to low 60s profit margins, which is insane. Gross margins of the company now still stand at 86%, and operating margins now stand at 75% as well. If you take a look at their market share, it matters a lot. They are only behind two other companies in the mobile segment, which includes gaming and other apps, but AppLovin is really focused on gaming. They control most of the market share, over 90% in that category. But in terms of overall mobile, where they're trying to expand a little bit, there's only two companies that stand ahead of them right now. Number one is Google's AdMob, and number two is URX. URX is actually a company that has almost 60% market share for advertising across mobile devices, and that company is owned, funny enough, by Pinterest. Moving on to some of these slides for AppLovin, you'll see that the numbers were absolutely phenomenal. Revenue grew 68% during the course of the year-over-year comparisons. Net income, guys, as we said, 59% net margins. And with those net margins, they've been improving their cash flow position. A first quarter over $1 billion in free cash flow, which is very good. Their revenue ramp curve is outstanding. Their net income from operations curve is outstanding. This blue line right here is the continuous just expansion, or rather holding now very close to 60% net margins, which are some of the best net margins in terms of any software company in the S&P 500 right now, as they were recently included last quarter into the S&P. Adjusted EBITDA, nothing to see here, up and to the right. And as you can see, cash flow and shares outstanding, cash flow numbers really ramping up hard this quarter. And what are they doing with that free cash flow? They're starting to buy back a little bit of shares. Not substantially, but a little bit. There's currently $3.3 billion of buybacks on the table, which is roughly 1.57% of the active float. The best chart, in my opinion, for AppLovin right now definitely is this one right here. It is their gross profit expansion. Look at this gross profit, because the company is controlling expenses really well. You can see that the orange columns are selling G&A expenses, and the purple column is research and development. They've kept that fairly streamlined over the course of the past few years. But as they scale their revenue, look at the gross profits, guys, right? So a company has very, very good cost control, and it just goes to show they have phenomenal operating leverage. As they continue to scale, their expense profile is not scaling at the same time, and they continue to power forward with very high gross margins. So we're going to keep this one a little bit shorter. I'm going to try something different this video and do a bit of, shorter excerpts for earnings and just do the big highlights and takeaways. Over 1.4 billion daily active users, which is very strong as well. Lastly, but not least, they're improving revenue and EPS at some very fast run rates right now. Their average through 2028, you're talking about a 25% per year revenue run rate. EPS growth is 40% per year. Look at these forecasts for this business. EPS is going exponential and revenue as well, hitting the exponential part of their curve right now with a phenomenal operating leverage. So the question right now obviously remains, is this company currently a buy at $620? Backtesting their 12 EMA, the chart looks very good in terms of just our technicals. We're in a little bit of a monthly pullback, not as far and as deep as I would like to see it, but to get that deep, you would probably need further S&P and QQQ consolidation. That being said, at 620 right now, your forward price to earnings is a 42.55. The PEG ratio is a very low 1.06. Now, keep in mind, they will not have this EPS growth rate forever, but for the next 3 years, on average, they will, so we can forecast at least until then. Trailing 12 months free cash flow is not the highest because the market cap obviously ran well ahead of the business right now at $210 billion. The price to sales, very high. Where do we see this as well? You see that with NVIDIA, to where the PEG ratio is really low because they're growing earnings at a phenomenal clip, but price to sales just has not caught up just yet. So this is really an earnings growth company. The sales will catch up over time, but price to sales, not the best metric for the company right now, kind of exactly in the same position as NVIDIA. And even if we were to put it out to 2028, price to sales remains a quite high 17.37. Is this company a buy right now? In my opinion, it is a nibble or a hold. It's not a large starter position. For that, I would like to see a bit more consolidation and better valuation metrics, possibly if the indexes cool off a little bit and we get some pullbacks here into 500, it would be really good. You might remember last quarter we covered these earnings when it was around 400 and it was a screaming buy at that point, a very interesting buy. Now it's pulled away. The PEG ratio is fairly low, but keep in mind this EPS growth rate will not last forever. Do I like AppLovin moving forward? Yes, but are we going to get the same amount of lift as shareholders back here or back here got? Probably not moving forward, but you can still get a very decent compound annual growth rate for a fast-growing company with insane margins, with a controlling market share in their own respective niche of advertising. So that's everything I had for you guys for AppLovin. Hopefully you enjoyed. Now let's move on to company number 2, which is going to be Axon. So Axon has been a widely talked about company over the course of the past 2 years because the share price has exploded, almost a 4x from the lows in 2023. If you guys don't know what Axon does overall, I will gladly show you. They essentially are a hardware and software company. Their ecosystem is very, very strong. So they do tasers and de-escalation training in terms of hardware devices. They have that. They have the body cams for law enforcement and a lot of military purposes as well. Whenever you watch some dash cam videos from police officers, you'll notice in the top right corner, it always says Axon. They have a very large position in US law enforcement, and they're looking to expand internationally. Dash cams as well, and finally drones and robotics. And they tie it all into a beautiful software ecosystem for digital evidence management, record management as well for all those dash cam videos, real-time operations, and AI productivity. A very strong company, guys. However, this company does have a few issues, and this is why it did drop about 20% after earnings before settling about 15% down. Take a look at some of their numbers real quick. They missed on EPS by 23%. They were supposed to come in with positive EPS. Sadly, they went negative. They did beat on revenue by a small fraction, and a big portion of that revenue miss, guys, sadly, had to do with stock-based compensation and hiring. This is a company that previously, in the last few quarters, had between 5 to 20% margins. It fluctuates a lot because their stock-based compensation and hiring fluctuates a lot as well. They do have very nice gross margins at 60%. Their operating margins, however, fell to negative territory. This is probably why the stock got crushed, missing EPS by such a wide margin, because you swing from positive to negative net margins when nobody was expecting it. that's not a very good look. And a lot of it, as I said, has to do with this ratio right here. Their stock-based compensation is just really not the best. 20.6% stock-based comp versus the revenue that they pull in. That is pretty awkward management in my humble opinion. They have to get this under control because when you trade at a very rich valuation, you cannot afford to miss on margins because of stock-based compensation. It's kind of a slap in the face to investors. That being said, the revenue growth rates are extremely hot right now. You're talking about over 30% revenue growth per year, and they've been doing that for a substantial amount of time. Right now, you can see here that their annual revenue growth rate over the course of the past 2-3 years has been in excess of 30% year over year. The blue line depicts that growth rate right there. Very strong year over year growth rates, and that should continue into the future as well. But hopefully they get this stuff under control. The operating losses as a result of stock-based comp. The operating loss of $2 million was primarily driven by increased headcount to support business growth, which is fine, but the stock-based compensation expense, guys, it killed them. Look at all these expenses here. As part of a cost of goods sold, they included $13 million in stock-based comp right there. From SG&A, they included $75 million, right, of 253, which is just too much. And R&D, they buried some stock-based comp in there as well. $58 million. As a result, resulted in a operating loss overall, guys. So just not the best. And when you do that much stock-based comp, you're just diluting shareholders. This company's been growing fast, but they've been compensating management and employees a lot for that growth. You'll see here is the outstanding share count from 2020 all the way till now. You've kind of gone up 50%, guys, right? Or not, just about close to 50%, slight touch over during that time, right? Which is not very good. Call it 40 to 50%, as a matter of fact. Not very good. So they have diluted shareholders in the process. The hopes are is as this company continues to scale revenues, they cut back on stock-based comp from performance targets and maybe start driving a bit more of that money to the bottom line. Because when you're a company that has, 60% gross margins, it's kind of inexcusable, when you're at this stage of maturity, right? For you to be popping out negative net margins for investors, it's just not a good look, especially when you do trade a bit rich right now. Now, moving on forward into their presentation, I just want to show you guys a few numbers in terms of their opportunities that they're looking to have. Total addressable market for them and their products and services is around $160 billion. And although you might see their body cams absolutely everywhere, we'll just look at how much their penetration is right now, yeah? So their penetration right now is under 15% for US state and local law enforcement. And that is let alone the amount of international expansion that this company can have as well. So the growth potential for this business is still very high. The addressable market is very large. And that's what you're looking for a company that's growing revenues very quickly. You want to see how close are they to their total addressable market? Are revenues going to be slowing down meaningfully? From the guidance of the company, no. They say they should be able to sustain between a 20 to 30% revenue growth rate for years to come overall. If we also look at some of their offerings in terms of the product flywheel, well, this is the initial product that they launched back in 2017, but now they've increased their offerings a lot to VR training, performance, a bunch of other metrics, and even including AI for some data analytics and insights into data management purposes for recorded footage and whole other things of that nature. 95% of revenue tied to customers are on subscription plans. And they also have 124% of net revenue retention, which does go to show that the clients enjoy their services a lot and even sometimes upgrade in their plans. Once they're in the ecosystem, it's hard for the customers to leave. And that's one very big good part of this business is the fact that their ecosystem is extremely resilient. Now, of course, they talk about the increase in U.S. public and safety spend, so obviously they will be benefiting from a portion of that overall. If we move into some financials, here is how they structure some of these deals with some of their customers, right? So in year one, obviously there's the hardware acquisition costs. You got to buy the tasers, you got to buy the drones, you got to buy the body cams, you got to buy the dash cams. That's the initial outlay. But after that, they keep you in the ecosystem with services and software and obviously some AI spend as well. So very, very, very solid right there. 75% software revenue over a 5-year term. And as over a 5-year term. And as we said, 95% of revenue is tied to those customers on multi-year subscription plans. So when they lock you in, you kind of stay in the ecosystem, which is really good. Kind of like something like Apple, right? Strong, consistent growth with attractive gross margin profiles. You can see there are two segments here, connected devices, which is the dark gray categories up and to the right. You can say that that's more of a hardware thing, and their software and services also up and to the right. So growing both areas of the business very, very well. If we move a little bit further here in terms of their non-GAAP net income, so when you remove the impacts of all this stock-based comp and whatnot, their margins are really good. So hopefully they'll be able to stop the stock-based comp or at least slow it down so they can actually start showing GAAP positive revenues and GAAP positive EPS as well, because as of right now, that was faltering too. EBITDA as well, adjusted, keep in mind, right? So they're removing the impacts of their slight mishaps during the quarter. It just goes to show, right, that if they stop doing this type of stuff or at least slow it down, the company can put up really strong earnings. That being said, right, in terms of forward-looking opportunities, future contract bookings, 11.4 billion. The backlog just continues to grow for this company. High retention rate, high subscription plan retention rate as well, and a high amount of recurring revenue. Very strong numbers for this fantastic business. If you can get over the slight red flag of the stock-based comp, and if you can also get over some of the valuations right now. They're growing revenue on average from now till 2028 at about 25% per year, an EPS growth rate 22%. They should be able to sustain this revenue growth rate beyond 2028. Hopefully they'll be able to expand EPS. That's only going to come with some better cost control for the business. Moving on to their valuation at $600, you're trading at a forward price to earnings of 78, a forward PEG ratio of 3.56, which is, I will admit, quite high even for these growth rates, and a forward price to sales of 13.86. Phenomenal company. As I'll show you, their revenue and EPS profile should be moving very quickly up and to the right on EPS and up and to the right on revenue as well. And to be quite frank with you, this is not either a company that is utilizing a ton of debt to get that done. Take a look at their debt profile right here. Not so much debt in relation to their market cap, only about 700, or rather right now, sorry, that's last year, 2.1 billion. And right now the company's trading for about 47 billion. So debt to equity is not too bad. They do have about 1.4 billion on the balance sheet. So debt's not a problem for them. Is Axon a buy right now at $600? Well, it always depends on your time frame. I do believe that at $47 billion, with such a large addressable total, with such a large TAM, I do believe this company can be a nice pickup if this is something that you like, and you can kind of move past the short-term valuation. I do believe they'll be able to grow into this. I do believe they can possibly be in the future a $100 billion company as they continue to display very strong ecosystem, very strong network effects as well. So Axon is a buy and a nibble, and should possibly be a buy and DCA. The best possible prices come down there in the 400 to 500 range, but I don't believe, unless the market really crashes, that you're going to be able to kind of wait to start to build a position down there. I would approach this one with a bit of a DCA approach, some here, and then if we fall a bit more, with a 3 to 5 year time horizon for market cap expansion and just continuing to execute on that revenue growth. That's everything I had for you guys for Axon. Hopefully you guys enjoyed that. And now, last but not least, Iris Energy, one of the retail fan favorites, the company that just struck a massive deal with Microsoft literally just the other day and kind of gave it all back after a bit of market turmoil. Now that we're sitting very close to the all-time highs, some people might be hesitant to position, especially into weekly overbought conditions. However, if we have a long-term time horizon, is this company a buy? Let's take a look at some of their earnings. Their earnings were insane. Moving on to their EPS, they beat EPS by 620%. However, this is fake news EPS. So once again, there's a lot of fake news EPS this quarter by companies realizing one-time impacts on their cash flow statements or their balance sheets. And this one is no different. They missed on revenue ever so slightly, but a lot of the focus is on the amount of contracts that this company can get moving into the future. So we'll go through their earnings and we will highlight some of those forward contracts as well. So taking a look at some of their earnings slides, you'll see here they made the 240 in revenue, that's for sure. They posted a big net income number and a very big EBITDA number. However, it includes an unrealized gain, primarily on prepaid forwards and capped calls. There it is right there on this very beautiful sheet. And you can see right here that they were operating at a loss temporarily, right? SG&A, depreciation, and some other things came in and kind of removed a lot of their operating profits. However, this is what actually put them to the positive side. So that's a bit of a drawback, but the focus on Iris Energy for most people is not on what they're doing right now. It's what they're doing in the future, namely stuff like this, the Microsoft AI Cloud contract, $9.7 billion in contract value over the next 5 years with a 20% prepayment for 200 megawatts in power. And we're going to talk about their power a bit later. This company is currently pivoting a lot of their facilities. So they have a few facilities here. If you take a look, they have a lot in British Columbia in Canada. Most of this power previously was utilized for Bitcoin mining. And they also had they were supplying their own energy through renewable sources such as hydro and other things of that nature, which did result in this company having some of the lowest kilowatt hours for production for now. The reason that I say for now is because they are coming online with a huge center right here. Actually, 2 centers in Texas, one for 750 megawatts, one for 2,000 megawatts. And Microsoft will be picking up 200 megawatts in Texas from them. Now, Microsoft did agree to prepay 20% of the deal, which gives them about $1.94 billion in ARR contribution every year for the next 5 years. Total for them, their goals are to expand to 140,000 GPUs by the end of 2026, targeting $3.4 billion in annual recurring run rates. This is huge because prior the guidance was 1.2 before they got the Microsoft deal. And with all of that, they would only be leveraging 16% of the 3 gigawatts worth of power that the company will be able to provide. The BC sites are currently online. However, Texas is still being built right now. And as you'll see, at the end of 2026, this is what they're going to be using, 460 megawatts, aka 16%. But just to show you guys, right, their BC sites are all built right now. They are transitioning from BTC, Bitcoin mining, to the GPU AI data center buildouts. And at the same time, they're building these 2 very large facilities in Texas. They're not ready just yet. However, they will be coming online into 2026. Deploying in phases for Microsoft at their Childress factory. And additionally, they got this really massive one here in terms of the expansion potential at that facility, but also this massive 2 gigawatt street water hub, which is the highlight of the company. 1.4 gigawatts of that capacity is scheduled to come online by 2026 and 600 megawatts scheduled for late 2027. You will see here that when we compare this with other centers of production, they are one of the current ones that have the highest amount. Beijing and Virginia are 2 locations where you have higher power outputs, but this will be one of the largest data centers in the country in terms of power output essentially, right? Or power consumption rather, that being said. Now, since we know that they're only going to utilize about 16% of the connected power that they can possibly do, well, of course, you know about some select customers that will be utilizing that 16%. But the next question you should be asking yourself, well, if they're only using 16%, well, who are the other customers for the rest of the 3 gigawatts? Good question. And the CEO couldn't give too much away, but here's what he did say, right? An analyst asked whether 200 megawatts for them, the Microsoft deal, was significant and whether they were interested in the rest of the Childress campus, meaning Microsoft, for more money. Now, the CEO replied that he is bound to some stringent confidentiality terms, but that there is definitely interest. There is appetite from a number of parties in discussing cloud and other structures well above the 200 megawatts that's been signed with Microsoft. So possibly hinting at either a further deal with Microsoft, depending how this existing one goes, or maybe even other deals from some hyperscalers because they have so much power that they can possibly utilize for some of those very big players overall. So looking good. Nothing bad to say about this company at all, guys. It's performing really well in terms of the revenue growth rate. It's growing higher, but they will smash these at this same time next year. These net income numbers are a little bit fake. They will be making some net income into the future with their high annualized revenue run rates. Microsoft is funding them a good portion of the deal. At the same time, they did strike some agreements with Dell for some CapEx, $5.8 billion in CapEx over the next 12 to 24 months as well. So they're being funded to be able to build and to be able to buy those GPUs, to buy the server racks as well. At the same time, they did issue $1 billion of convertible notes raising a little bit of debt. They did finance as well $400 million of GPUs, and they do still have $1.8 billion of cash on hand, which will help to cover some of the CapEx expenditures, but you shouldn't be surprised if they are going to issue a bit more debt and maybe even do a share capital raise. So possibly, it's not for sure, the company hasn't announced it yet, but possibly a dilutive event on the horizon, or possibly needing a little bit more debt, as we do know that these are fairly capital heavy businesses, right? However, the promise of future deals, or rather the indirect promise of future deals, that's what has people really hyped up about Iris Energy. At the current stage, it's a $17 billion market cap company. That Microsoft deal is a huge, huge, huge amount of money for them overall. And of course, as we said, their total deployed, or their total contracted power right now, is only 16% of what they can actually do. So you can imagine the amount of contracts that they can further sign, right? They could probably sign another $30-40 billion worth of power arrangements for the next few years in terms of hyperscalers or other players that would want to possibly get a piece of their compute power. That being said, at $17 billion, the numbers, they don't make sense right now because the company is currently pending deals. They're growing revenue, if we take what they say next year, right? Growing revenue at over 50% per year, over 50% easily. EPS growing it at over 80% per year, which gives them numbers that are kind of all over the place. You really have to go out to 2028, 2029 to model this company better when they're actually going to be at full capacity and we can see some true EBITDA and operating margins. But at a first glance right now, it is sitting at an under 1 peg and a forward price of sales for the end of 2027. I took 27 for price of sales because it's a bit more accurate at about 7.35, which is not all that bad, guys. It's not all that bad at all. Matter of fact, I think this is a little bit low. If they get more deals and this is actually their true revenue run rate, it would actually be closer to a 4 or 5 price to sales, but I'm not including most of those deals right now. So I'd rather take a more conservative valuation. But if I were to go aggressive on this one and just take Wall Street's estimates without a portion of the Microsoft contract, just be very conservative, guys, we should be trading at like a 4 price to sales, or possibly even under as well. So the company right now, in terms of how much they can expand from 17 billion, I'll be honest with you guys, it is still very cheap. This is a company that can very easily 2, maybe even 3x this market cap, depending on the size of the deals that they'll be able to get and how advantageous those deals will be for the company, because they have the compute power to kind of rent out to whoever actually needs it. 3 gigawatts is absolutely massive. Now, it'll take them a year and a half to build that out, but if this is a multi-year play for you, it is still relatively early. So if you wanted to kind of buy in and potentially DCA, I do still think at these market caps, it does make sense. Sure, you're not getting as good as a deal as we talked about it last quarter, but still in relation to the next 3-5+ years of expansion, I do still think there's a lot of meat left on this trade where you can have some pretty attractive compound annual growth rates. So keep that in mind, right? But always pay attention to these neo cloud providers, right? How much debt they have to spend to get that done, how much CapEx they have to get that done, and when will they be able to actually generate some positive margins from this and pay off a lot of that CapEx with free cash flow and generate positive EBITDA margins. So keep that in mind, right? It's a bit of a complex scenario, but I do still believe we are still early on Iris Energy. And that's everything I had for you guys for the overall earnings breakdowns. Hopefully you did enjoy. I tried to keep them a little bit short and more to the point without talking about them too much in detail. I'm trying to do this video. I'll try to do this video a bit quicker because I know we've been making very long videos recently. The sentiment in the market was bad last week. We had a ton of earnings to cover. So moving forward, the videos will be much shorter. I do promise that to you guys. I know you guys like the long videos, but I'll try to keep them to what I used to do, right? 45 minutes, 1 hour type of thing. So now let's move into some of our technical analysis, shall we? So moving into the S&P 500, as we said, guys, we did clip into several major moving averages. The 50-day EMA, which we barely clipped into after the China news just about a month ago at this time, but prior to that, not before. And this was one of the concerns from the market that I've been raising as well, right? In terms of the fact that we are very extended from not only the daily EMAs, but also from this weekly 12 EMA. Now that we've tested it, we got a bit of institutional support, got a bit of algo support as well, because institutions and algorithms really watch that 50 EMA very closely. And now we have a nice little bounce underway. Additionally, though, there is more to the bounce. It is not a concentrated bounce. It's a broad market bounce. Percentage of stocks above their 20-day EMA, checking on the market breadth, it's looking like it wants to curl. It's been bottoming out here over the last few days in terms of your short-term moving averages. If we get a couple more days of strong market breadth, it's really going to help lift the markets and get us out of those concentration risks. Percentage of stocks above their 50-day EMA, you can see the same thing, right? It was very, very weak heading into this week of trade, which is why I was very cautious on my positioning. I was waiting to see if they were going to bring back the market breadth or just sell off everything regardless, right? It seems as though they want to be making a bit of a push here. And I'll remind you, we don't get down into these low reads very often. Percentage of stocks above their 50-day EMA, only 38% of all stocks above that, which is competing with some of the either January lows or some of the tariff sell-off lows as well. So we are looking good for a bit of a bounce, but it needs to be more than one day. Monday and Tuesday's action is going to matter a whole lot. Percentage of stocks above their 200-day EMA, well, we're still standing above the 50% mark. You don't really want to dip this below 50 because, I mean, when you're recovering from a big tariff sell-off, it's okay. But when you're under 50% of all stocks above their 200-day moving average, guys, it's very weak participation, right? To where a lot of companies would be hitting either close to or at 52-week lows, and then a concentrated portion of the market hitting 52-week highs. That's not what you want to see. As of right now, good bounce, but the bulls do need to convert this very attractive bounce into a new hourly uptrend, get us some lift, and start taking back some of this very big retracement. The daily uptrend was almost lost, no close below and no close below support either. 674 down to about 667 is the support range. We are holding what you want to see from the bulls right now because this was a big retracement, guys. 100% retracement, right? What you want to see is the bulls being able to, oops, my bad. What you want to see is the bulls' capacity to next week generate at least a 50% or 618 retracement size to about 675 to about 679. Then you can say, okay, we've created some space off the lows and the bulls might be able to get this back. Why would we have that bias? Because we never lost the higher time frames. It is still a gorgeous weekly uptrend and you might just be looking for more, but pay attention to the size of this daily bounce. If we get it, it's going to matter a lot. Very weak bounce and not setting new short-term trends, right? If we just roll over like this, it's not going to look very good, guys. You will be breaking to more lows and possibly going back and testing the next area of support, 655 to 650, but not looking too bad right now. Just remember at all times, these catalysts, the bearish short terms and the long-term bullish tailwinds, these can take you lower in the short term, but don't forget, right? We do have very strong bullish tailwinds overall in the markets. Moving on to the QQQs right now. So the Qs, same concept a little bit, coming into their 50-day EMA. First time that we've clipped it, guys, since all the way back here, early September. Second time since the lows of April. On the weekly timeframes as well, clipping into the 12 EMA, which is also the second touch. So now, finally, after being up here and me saying we are very extended, we finally get the pullback that we were looking for into a very important EMA. That being said, the daily higher lows were cut, but not closed below. So you can't necessarily say that the bulls lost this daily uptrend completely. It's a very big retracement size. Now it's up to the bulls. Get me the hourly uptrend going, create some distance, and give me a decent retracement size. I will want to see a bounce at least up to 619, up to about 621 to give myself the impression that, okay, we haven't lost support. We're currently holding above it. Give me a nice bounce, and we could talk about the conversion back to a new overall daily uptrend and just the continuation of this gorgeous weekly uptrending pattern. So looking pretty good right now. A lot of stocks have come down. There are some great opportunities in the market, which is not the same thing that we could say about a week and a half ago before we flushed down on these levels on the indexes. Moving on to financials right now. Financials, decent push, trying to go for the daily uptrend. Resistance ahead, 53 down about 52.86. Below though, we're kind of trapped between two levels. Resistance above and big support below, 52 down to 50. I have been saying that this 52 to 50 area is a great area to be building some swing trade longs on XLF. Whether you enjoyed the banks when they sold off to the designated levels that we were looking for, JP Morgan down here, 300 or less. We were looking for the swing trade, looking good right now. Goldman Sachs, same procedure, coming into the support lows, going for higher. Or even if you're looking for other companies that we've been talking about on the channel, SPGI, nice swing from the lows. We were talking about this one down at about 680, targeting resistance. Financial data companies finally moving higher. Moody's Corporation also bouncing out of support, trying to go for it a little bit. The two that we're missing right now, the big weights, are Visa. Need to see Visa start participating. Still a great opportunity to buy down here, in my opinion, and MasterCard as well. This one too needs to start reversing some of this weekly downtrend that we've been in, which in all reality is just very healthy, kind of sideways monthly consolidation around its own respective 12 EMA. Visa and MasterCard, probably some of my favorite opportunities in the financials category right now because they've just been left behind for the last 6-7 months. On to healthcare right now. Healthcare has been one sector that throughout this week has been very strong, right? We were missing tech for a good portion of the week, but not healthcare. It did a good job of kind of trying to uphold a bit of the S&P, and the weekly time frame looks good. It looks like the bulls want to challenge the resistance again. 148 down to 145. Weekly uptrend is very nice, so just wait for that continuation possibly into the range. Nice momentum here coming into the range, guys. What we want to see is the breakout and then retest, right? It's tough to take longs into resistance. If you get the breakout and the retest, that would be a very nice opportunity for some swing trade longs because then they claim the level, they confirm the level, stop loss below here, and then you go for the all-time high trade. Obviously, I already have positions because I position it down here. But if we're looking for new positions, you do want to see the confirmation of the close above, the back test, and then it gives you the best possible entry. So healthcare not looking too bad. Moving on to semiconductors right now. Semiconductors, almost coming and challenging those daily lows. It is still a very nice daily uptrend, right? But that being said, we've retraced a lot in the recent past few days. On the weekly, it's not looking too bad. It is still a phenomenal weekly uptrend. Any further consolidation could bring you down into the 12 EMA, which is why I pay so much attention, guys, to the weekly 12. When you're too far away from it and you have overbought conditions, it's just not the best risk to reward setup to position up here. But if we wait for some dips, maybe not on the index, but on individual names that pull back into support, you might have some very nice opportunities. Something kind of like what NVIDIA just did, right? Big pop off of here, off the GTC conference, big weekly push, got extended from the 12, came right back down, back tested it with support. Those are the types of plays that I'm kind of looking for when I see a semiconductor index that's extended. I'm looking for some names that are coming back into support. So we'll see what we get. But as of right now, not too bad, decent bounce, but you do need for them to kind of confirm some of the lower time frames, right? You got to get this hourly trend back towards the bulls because we haven't really had one since we started flushing right there. Lastly, moving on to the Russell. The Russell, not too bad either, but same thing as the rest of the market, right? The Russell had the daily downtrend going. We did flush the lows overall, which means you were into a phase of weekly consolidation. Same concept. We were up here. I was saying, wait for the backtest of the 12, something that has not happened since the month of July. Now you get the backtest of the 12. So we have some trade opportunities here, but with a DCA possibly further into support. Because if they can't hold this and we just roll this one over, guys, right? You don't want to be fully committed at this level. We want to embark on a DCA process down into our monthly support level, which is 231 to 225. So the Russell, not looking too bad, but just watch for the possible backtest overall. It would be a higher probability trade. XLP, these are some of the segments of the market that are coming back finally. Look at XLP tagging its 200 weekly EMA. When does that happen, guys? Once in October 2023, the bear market 2022, and then COVID or the Trump tariffs of 2018. It does not happen too often. When it happens in confluence with some April tariff lows, right? And also previous highs, resistance, which are current support levels, decent time to position when you know market breadth has been weak and value has just been sold off as if nobody even wants it anymore. So nice little trade opportunity right now. Stop would go below the lows. You're just looking for a possible upswing back here and an eventual recapture of this if the thesis is for market breadth to improve off the lows. So probably one of my favorite sectors. It's not the sexiest sector. It doesn't move the fastest, but we do have a nice risk to reward entry from these lows in my opinion. Moving on to utilities right now. Utilities was always consolidating, and you might remember me here saying, wait for the pullback to the 12 EMA. It does it all the time, right? Pulling back into some of the previous highs, not quite getting there, but you can tell what they're trying to do, right? Pull back to the 12. Sometimes you can go a little bit lower if you want to test support, but it is a nice area to be looking at some utilities names. If this is a style of trade that you want, names possibly like names like possibly like VST, which also came down into its own level after earnings. That's a strong one, man. Looking for monthly consolidation into there. If you're looking for some of the power plays for data centers, right? Some of my favorite ones include VST. Another one of my favorite ones includes Duke. Duke also pulling back to its own 12 and into previous highs worth of support, right? If I do a little box right here, you guys will probably understand that better, where we're pulling back into, right? clear backtest of the highs, and maybe something like a next era energy, which, I mean, is currently stuck. It's stuck in a level right now. It's like these guys right here, yeah? It's currently stuck right now. The best entry was when we first brought up this name down here. But if we're looking on the longer term time frames, we haven't done much in the past 4 years. And this company has great fundamentals for the longer term future. Probably still one of my favorite plays for power requirements for the data centers. And lastly, real estate. Real estate doing a good job bouncing out of these lows. I mean, it's going to be a very bumpy trade, whether you're in mortgage companies or something maybe like the home builders like XHB, but you can clearly see what's going on here, right? Weekly bouncing out of support, slowing down a little bit. This is a monthly higher low. Big breakout. I was saying up here, wait patiently for the higher low. It's the re-entry. We talked about this trade down here. That was entry number 1. This is entry number 2. If you have a thesis for 2026 and 2027 expansion on some segments of real estate overall. So not that bad. Real estate just bottoming out as an ETF overall down there. Moving on to the VIX right now. The VIX, not too bad, right? We did peak at 22. And after that big bounce, clear flush. That's why on Friday, early morning, there was some phenomenal opportunities, guys, for selling some options. When the VIX is high, first thing you need to think about is sell strategies for options, right? Whether selling covered calls on names that have ran a lot, for some trades that you might be in, or possibly just selling some put options on some companies that have been pulling back that you might deem to be at favorable entry locations right now. We'll see what happens on the VIX, but we are still high. And when the VIX is high, it is sometimes time to buy. And you can do that by utilizing short puts that have increased volatility on them now. On to yields, and there's nothing really to talk about on yields, so I won't spend too much time on it. Of course, yields are all over the place right now because of the fact that, well, you know, depending on the jobs reports or commentary from Fed members, the December rate cut is still in question right now. The probabilities for a 0.25% cut in December still stand at 67%. Prior to the meeting with Jerome Powell a few weeks ago at this point, it was in the 90s, but now since that's in question, you might see that yields are a little bit choppy, and as a result, the bond trade might just be a little bit choppy as well. It wasn't as clear as it was leading into that meeting when the expectations was for 2 very clear cuts. So Jerome Powell kind of poured some water onto the bond trade overall, but I do still think that this one is moving in the right direction over the course of 2026 as we move forward into more and more rate cuts. Gold, moving on to gold right now. Gold could be something very interesting for us. We have a daily downtrend right now, and now the bulls have stopped. Now, we haven't quite touched the 12 EMA, but the 12 EMA is curling up a little bit. We are currently, guys, trapped between 2 levels, looking for the market to confirm us direction before possibly positioning. Very simple trade thesis right here. If they get the daily uptrend break, the entry goes here, the stop loss would go below the lows, then you are targeting expansion beyond the all-time highs, maybe to some psychological numbers, 45 and then 5,000 for a continuation of this weekly uptrend. As we do have the higher time frames, we've cooled down some of the weekly time frames as well. But in my opinion, waiting for confirmation is a much better signal. For the break, you get a clear stop loss, because if the flip side is true, then it becomes a short for further consolidation. If you break down from here, daily downtrend continues, you would go short on the break of this level, stop loss above this guy right here or above the highs, and then you just go for further weekly consolidation, also perhaps into some psychological levels, 3,750, 3,500 for a bigger monthly retracement on gold, right? So I'm a big fan of waiting for the break of the range in either direction, and we'll just have to take this one day at a time to see which way it breaks and whether we can set up some trades from there. Moving on to our crypto names right here, Bitcoin and Ethereum. Nice bounce on the Friday session, but you can see Saturday and Sunday candles, not too hot. The clearest time frame for me, I mean, we are in a daily downtrend right now. We're bouncing off these lows, big liquidation break, cut the lows below 100,000, possibly taking out a bunch of liquidity down there, right? Weekly downtrend, but the clearest time frame of them all, since we're between 2 ranges, right? 120 to 115 resistance, 107 down 100 support. Clearest time frame for me is the monthly, right? Nice monthly uptrend, still just in the context of monthly consolidation. It is a time, in my opinion, to be adding to Bitcoin if you do have a long-term thesis on Bitcoin. Here, and the next line that you would be adding would be low 90,000s. Those, respectively, would be 50% retracements right now and 618 retracements just under the 95. Just under the 95. You take a look, guys, at the last time that we did this, right? We did come down to the 50, not quite the 618, but Bitcoin likes to do this a lot, right? It does like to come down potentially to the 50 and maybe 618 sometimes in the context of bull market expansion. So keep that in mind. On to Ethereum right now, bit of the same context, right? We do have a daily sweep of the downtrend right there. They dropped a level. They were trying to hold on desperately to 4K to 3,700, which was a big one, right? And we lost it. And when we were here, I was saying, it's not looking very strong, right? The bulls were struggling to get some momentum out of this range. We rolled it over and I was saying, yeah, not too bad of a buying opportunity here, but maybe even save some buying power if you do break and you do go for that full 50 to 618 retracement, which would be here, right? 31 down about 2,800. We did backtest this region, and I do believe it's a nice DCA area if you have a long-term thesis on Ethereum. That's everything for our overall market rundown. Hopefully you enjoyed. Now let's get into some of our tech names, and I'll try to run through these as quick as possible because we do cover them every single day. Just going to give you guys some updated thoughts. So Apple holding the highs fairly well right now. Daily uptrend is still in control from the bulls. Clearest time frame, in my opinion, guys, is the weekly. Once again, we are extended from the 12 EMA. We do have a bit high valuation concerns right now on Apple, trading about a 3.2 peg. Their earnings were fantastic. I do believe they'll have a very good Q4, but it's very tough to position all the way up here when you're extended from the moving averages and you have very high valuations on this legendary stock. If we do get a pullback perhaps into maybe the 250 region, I could be interested for some swing trades, but as of right now, not adding to my long-term portfolio and also not swing trading at these highs either. On to AMD. AMD, phenomenal pullback over the course of the past week, but we are still a little bit extended. However, the pullback did allow us to cool down the weekly timeframes, which we were talking about that last week, how these weekly overbought conditions were a bit of a concern, right? Moving on, they did cut the daily higher lows. So we have, right, given back all of this momentum. Watch the size of the bounce, just like on the indexes overall. If you can get a 50 to 618 bounce, well, the bulls might be able to actually go for the full V shape. If not, they may have to do it in a two-step process. But if you gain back the hourly time frames and stop here and reverse, unfortunately, guys, and lose that hourly time frame, you guys know the drill, right? Then you are setting the lower high, and you might just be going a little bit lower into further weekly consolidation and maybe into this 12 EMA. My favorite way of playing this one with good volatility is selling some put options if we want some stock down there in the lower 200 region, which would be a nice backtest of that level and the lows of the OpenAI deal announcement overall. Right now at around 240, the company is still a buy for a long-term portfolio, trading at about a 1 peg with phenomenal revenue and EPS growth rates. Company's fundamental thesis is still very well intact. I'm still very bullish on this company into 2026 and 2027. Moving on to Amazon right now. Amazon coming down and doing the perfect back test. So it is a nice daily uptrend, nice pullback from your earnings and directly into our support range, 239 to 232, which we were talking about back here. We were saying watch for a possible swing trade entry upon the back test of support. It did offer that up on the Friday session, but if we pull back a little bit more, just a little bit more time to build those swing trades out, I will be also a fan of selling some put options down here in the 230 range as Amazon's valuation after earnings is still quite good. It was good at 250, trading out at a 1.64 peg, down towards 230, shave 10% off of this, and you quickly fall back under a 30 forward price to earnings and around a 1.5 peg. Amazon's still one of my favorite companies for growth into 2026. Monthly uptrend is still fine, and I do have a price target by next year of about $300 per share. About 280 to 300 would be fair for Amazon in my opinion. Moving on to Google right now. Google holding the highs really well, down 2% on the Friday session, almost lost the daily uptrend, right? Further flush of this guy right here, 276, and you will lose it and you will go into weekly consolidation. Google is the same concept as some other names. We are very extended from the 12. If we get a pullback close to the 12, maybe we can find some swing trade entry opportunities. There is some divergence on Google right now. Higher highs on the price, lower highs on the RSI. So just be a little bit cautious with that. So tough to buy Google up here for some swing trades. It's a very greedy entry in my opinion. I'm not saying it can't work. It's just extremely greedy without a better pullback entry. That being said, at around 290, 280 for longer term shares, it still does make sense. Trading at a 427 and a 1.8 peg. So the valuation is not terrible. At 250, it gets a little bit more manageable, but I'm still extremely bullish on Google. So am I nibbling some long-term shares up here as part of a DCA plan with my paychecks or something like that? Yes, because the forward rates of return still make sense for me. But am I swing trading up here? Well, the answer, unfortunately, is no. Google remains a hold or a bit of a nibble for the long term. Moving on to Meta right now. Meta bouncing out of a key area, guys. They grazed 600. Now, I know it's slightly off my box, but it is the good old 600 level, right? Meta, daily oversold conditions. When's the last time we got this oversold on Meta? Twice. One string tariffs, and the last time was 2022. So it has to be notable to you when you find confluence like this. Daily rare oversold conditions and a big area coming up for some confluence. Phenomenal area to be picking up some Meta shares, in my opinion. Clear daily bear control. We will see if they can get a bounce going. On the weekly as well, it is a weekly downtrend too, and in the context of monthly consolidation. So it's tough to say whether the bottom is in. Normally, if you want a tradable bottom, you have to get a daily uptrend going, and then you trade the break and the higher lows, right, for your stop loss, and then you can go for the weekly bounce move back into possibly 700. But it's tough to call this as an absolute bottom without seeing confirmation on the price action just yet. That being said, is it a great location for some 2027 leap call contracts on this beautiful monthly consolidation? Is it a good location for some shares? Absolutely. Around 620, 630, the price of Meta on a forward basis, you're trading at low 20 multiples, a 1.63 peg, so I am buying some more shares myself. On to Microsoft right now. Microsoft also pulling back. Now, Microsoft almost losing the last line of defense down here, 495, something they have not lost really since the month of July, and the backtest here, September. Clear daily uptrend unwind, no daily oversold conditions just yet, short-term oversold conditions on the 4-hour, yes. Can we get a bounce? Yes, but once again, you always need to watch the size of the bounce. On Microsoft, for them to be able to reverse this, guys, you need a 50% bounce, at least 524, 525. You can give me that bounce over the next week or so, then the bulls have a chance at getting this daily uptrend back, reclaiming the support, because now we're on the verge of losing it, right? Give me a 50 bounce, reclaim the level, and then we could talk about possibly some swing trades, right? With the stop loss below there, then going for the all-time high expansion. That's how I just wait for my confirmations rather than trying to call the bottom on some things. For swing trades at least, right? In terms of long-term positioning, right now that we're under 500, it's not that bad in terms of valuation, but I would be a fan if I find Microsoft here at a backtest of the 12, which Microsoft does do, more often than not throughout its history, right? If we can backtest 475 or even a bit lower, I'd be a fan of adding some shares. It's not that bad right now at the low 500s. 475 would be really good. We'd be right around a 30 forward price to earnings and right around a 1.7 peg, which is pretty good. Moving on to Netflix right now. Netflix also still under resistance, 1150, 1150 down to 1100. But keep in mind, you might see a lot of trading volume come into Netflix in the next 2 weeks because they're about to have a stock split coming up by the end of this week into the week of early November 17th, right? That being said, it is still a weekly downtrend, so keep that in mind. The clearest time frame for me on Netflix, guys, is the monthly time frame. Coming back and perfectly backtesting our monthly 12 EMA. Done a good job of cooling down the monthly time frames. The weekly time frames are nowhere close to being overbought, so I am a fan of buying some Netflix shares. I'll be personally waiting for the stock split to do any short-term swing trades or some leaps, but down here, for some long-term shares between 1,100 and 1,000, I am a big fan. The valuation definitely makes a lot more sense than where it used to be at $1,400. Moving on to NVIDIA right now. NVIDIA, perfect backtest overall. Daily downtrend, nowhere close to daily oversold conditions, even if we unwound an entire 20% move. But short term, you do have some oversold conditions clipping out, right? And they need to convert this into a new hourly uptrend. Beautiful V shape, need to convert into the hourly uptrend and get the bounce going because you lost the daily, right? You didn't lose the weekly. You lost a lot of the weekly, but you didn't lose the entire weekly. That would be a break of 176. Still a weekly uptrend, but you gave it all back, right? Now, NVIDIA is NVIDIA. They can V-shape this, surprisingly, right? But logically, what you expect after such a deep retracement is a two-step recovery process, maybe into their earnings, which will be in about 2 weeks' time. Is NVIDIA a good buy here? Well, as a matter of fact, it actually is, right? If you take a look at their forward price to earnings at 206, now it's about 10% lower than that, roughly, right? So it's trading at between, like, let's say a 1.15 to 1.3 peg for forward. Not that bad at all, guys, with their updated guidance. I am very bullish on this company. So either leaps from here, if you want to go for a bit of a greedy long on this company for 2027 leaps, or maybe just some shares to accumulate a position into NVIDIA's forward guidance, right? Not the worst opportunity now that we have pulled back all that amount. Personally, myself, going for some leaps and also some short puts under the market that we've been patiently waiting for upon this pullback with the increase in volatility. On to Tesla right now. Tesla down 3.58%. They tried to go for the breakout. The market just wouldn't give it to them, right? So we're kind of back into the gulag. And I call it the gulag because we've been stuck here for like 6-7 weeks at this time, right? Price action is somewhat unclear. You could make the argument that this is still a bit of a bull flag here as we had a massive move and we didn't give back too much. That being said, the cleanest area for a backtest would be backtesting support 405 down about 382. Give me a monthly backtest and maybe we can talk about some swing trade longs on Tesla overall. As right now, the price action is slightly awkward. So no swing trades for me on Tesla. Tesla is a stock with phenomenal volatility, so I don't blame you. I know a few of you guys enjoy selling short puts below the support level down there, but I'm not currently embarking on any swing trade longs as of just yet. On to Palantir. Palantir pulling in NVIDIA, breaking out from a range, 20%, and then pulling back into the same range. We did not lose these lows. Very important for Palantir in my opinion. And now same concept, right? Palantir is a company that you wouldn't be surprised if they V-shape this. Usually after 100% retracement though, you would have to kind of two-step the procedure, right? If we do something like this, right? Some people just want to take a swing trade long from here with the stop loss below there and just say, you know what? I'm not going to wait for confirmation. I'll just go for it. Other more patient traders will wait for a confirmation of the uptrend, buy in here, and then stop loss goes below there. Then you target psychological expansion to 20, 225, etc. Whichever you want to do is fine. There is a current setup for it right now. They have not lost the weekly, still in a nice weekly uptrend overall. And the company did have phenomenal earnings. That being said, we did cover them after earnings. The valuation is all over the place. But you know what Palantir did recently? They cooled off the monthlies. Now we're still trading at an 80 monthly RSI, but they cooled them off a little bit. Where Palantir would be kind of a nice pickup for me in terms of just some longer form swing trade shares or whatnot, 150, 140. I'm not saying it's going to get there. I'm saying if you're asking me for my most attractive level, it would be a backtest of the 12, something we have not done since the tariff lows. On to SOFI right now. SOFI also with a phenomenal bounce. SOFI started off the day on Friday down 5%, made it all back and closed in the green. Huge move, guys. Almost a 10% swing from the lows right there. Looking quite attractive, but we are in a daily downtrend still. Overhead resistance stays put at about 30, down about 28. This little box, previous resistance, they try to use it as support, go for the breakout. Didn't happen. The market's unwound. So now we're just in the context of a bit of weekly consolidation. Backtesting the weekly 12. We did not touch this at any point since the month of June. So very attractive possible entries. I was telling you guys that if SOFI pulls back, looking for some shares, but also for some short puts because you're just looking for a monthly backtest of support, which was 25 to 22. Still very interested if SOFI remains a bit soft this week for any which reason, selling some short puts down there, accumulating some more shares as well because we derived their valuation after earnings. And at 31, it made sense. In mid-20s, it's the sweet spot in my opinion. Moving on to Uber, another company that had very strong earnings last week, which we covered on the channel. This one also going for the full retracement back into the support lows. Support lows right now, 93.35 down to about 90.5. If you lose this in the next week, guys, it's a weekly downtrend. However, when in doubt, zoom out, right? You're just looking for a bit of a monthly retrace into the 12. If you come down to the mid 80s, Uber is a definite pickup for me. We did their valuation at about 94 after earnings. We saw that the valuation was fair, decent free cash flow yield, okay PEG ratio, decent forward price to earnings, very strong growth metrics on monthly active users, bookings, trips, mobility, deliveries, all that good stuff. So if I can find Uber for some short puts down here or for some shares, I'm a big fan of playing this company. On to TSM, our last one. TSM, not too bad, but look, we came back and perfectly tested, guys, the 50-day EMA, which we haven't done since September, since this massive rally. We did lose the daily uptrend though, so it stands to argue, you're gonna need a 50-618 retracement and get it back in 2 shots. Maybe they can V-shape, but logically you would expect maybe a recovery in 2 steps. That being said, it's kind of the same as it was back here, right? Sideways consolidation with a slight negative bearish bias. Same concept I was telling you up here. Be mindful, we're far away from the 12 EMA. I would want to see the price catch up to it and test the 12 EMA. We almost came into it, guys, and that's kind of what I was looking for possibly some short puts or adding some shares to the long-term portfolio. We did the valuation of TSM after their earnings. Phenomenal company, doesn't trade too rich up here in the 280s, 290s, but this would definitely be one that I would be willing to DCA into. If we start losing the timeframes, you might go for a more full monthly retracement, and I would be buying all the way kind of down here into 250, 240, waiting for that 12 EMA on the monthly to kind of catch up, as we were able to clip this one several times throughout the year so far. And that's everything I had for you guys for the overall market rundown. Try to keep it a little bit shorter than usual. Hopefully you appreciated that. Now let's move into some of our biggest gainers and losers. We'll spend about 10 minutes on this, maybe less. I'll show you some plays that I'm interested in. And thereafter, guys, we'll get into my portfolio, spend about 5 minutes on that as well. Okay, so of this entire list, I'll kind of highlight some companies that I might be looking at for possibly some short put opportunities or maybe even some shares to swing trade. Number one is definitely going to have to be CLH. I am a fan after their earnings of possibly putting in some bids down here, 40 all the way down to about the mid 30s for some short put purposes. You've sold off this one very aggressively because of people not understanding their accounting procedures. Daily oversold RSI right now, and the valuation in the lower 40s, guys, is actually not that bad. The PEG ratio is pretty cheap. Price to sales is pretty cheap as well. We know consumer sentiment has been fairly weak on anything discretionary, but this one could be a very interesting play because I do believe that the market cap expansion for this company is very real into 26 to 2028. So down here, 40 to 35 is definitely something that I want to have a second look at and maybe play some short puts, but even for some longer dated shares, if it's something that you like, not opposed to it at all. We talked about Iris Energy, but I didn't really say what I was going to be doing. Iris Energy, to be quite honest with you guys, is probably going to be something that I'm playing more aggressively and probably accumulating some shares from the 60s. And if we fall lower because the market sells off down into the 50s or 40s, I'll be building a bit of a position that I'll be looking to kind of hold into 2027 and 2028. Of all the other data center plays, such as NBIS, such as APLD, such as other ones, CIFR, I do enjoy Iris Energy the best. And as a result, I will be starting to build a position in this company and also maybe even playing some short puts under the market for some volatility purposes. Moving on to Trade Desk, I'm sure a lot of you are asking the question, should we be buying Trade Desk down here? Well, my answer after earnings was unfortunately no. You have some other fantastic opportunities such as Meta for advertising, right? Meta, they are obviously a much bigger advertiser, right? Trading at lower multiples than Trade Desk at this current time. Trade Desk also faces very steep competition from the likes of Amazon, which is not usually what you want to see. So me, unfortunately, on this one, it is a pass. Moving on to a company like Figma, let's say. Well, Figma could be quite interesting in the low 40s. We're trading right around the same market cap that Adobe tried to buy them out for just a few years ago. We've really gotten crushed since that IPO period all the way to the downside. They had pretty decent earnings. We didn't cover them on the channel, of course, but they did have very decent earnings recently. I wouldn't be opposed if we're a fan of Figma, if we wanted to have it. It's not my favorite play in the market, but we can see some upside from this low 40s location if we wanted to take a maybe, 12, 24, 36-month type of swing trade on this company as they keep expanding their business model. Talking about a company like ARM has come down and perfectly tested support, 150 down to 139. There's a few problems with this company. Number one, it trades very, very rich right now on a PEG ratio and on price to sales. So out of all the semiconductor companies out there, or chip companies or design companies, it's okay for a swing trade if you put a stop below here, let's say, and we try to go for the expansion beyond the all-time highs. Rising tides lift all ships type of trades, right? It's not my favorite semiconductor trade to put in a long-term portfolio just because of valuation, but a swing trade from here wouldn't be the worst proposition. Talking about Elf Beauty's come down even more after earnings. Down here, guys, into the 60s is where I'd be looking to sell some put options. If I get assigned, I wouldn't mind at all. The premiums are good. We're currently very daily oversold right now at a 16 RSI. The market cap is now down again into the $4 billion range. And we covered them after earnings, right? After earnings, right? When they were trading around 93. They had an already low PEG ratio down at 73 right now. Take another 20% off of this, and you'll see we're trading at very cheap multiples. So accumulating some shares for a longer term expansion trade for the business or short puts under here, I'm not opposed to at all. Actually, one of my favorite small to mid cap plays. On to CoreWeave. CoreWeave coming into support right now, 100 down to about 86. I'll pay attention to what they have to say on their earnings call, which will be Monday, essentially, right? And if we somehow make our way back down here, I will be buying a few more shares of CoreWeave. I think they have a good chance of being able to expand their market cap. They're one of the larger players in the data center neo cloud providers, right? And although they do have a lot of debt for what they do right now, NVIDIA is kind of backstopping and has agreed to pretty much buy any excess capacity that the company would have. So you got a nice, interesting backstop. We've got a very good retracement here, and I do think there's some good risk to reward. I have a combination of shares and leaps from this area already. Moving on to Shopify, pay attention to Shopify. If we fall off a little bit more and go for a more full retracement, we did touch the 12 EMA. If you go for a full monthly retracement down here to guys, the mid 130s, we cover them after earnings. We derive that their valuation is a bit high, but if I can get maybe a 130 to 120 entry, that would pretty much be ideal if we're looking to add to any long-term portfolios, maybe selling some short puts or some swing trades like that. It's still a bit extended on the technicals and also on the fundamentals as well. And lastly, we could take a look at something like maybe an Oracle. Oracle is pretty much giving back the entire earnings move that they had just about a quarter ago. No earnings yet until the month of December, but we did fill the entire gap. We are almost daily oversold conditions right now. It hasn't been an easy stock to hold on the short-term timeframes, oscillating and very close to the 200-day EMA, which is culmination with support down here, 226 to 215. This is an area, if I had a very large portfolio and I wanted to sell some put options on Oracle and not mind if I get assigned, this would probably be the area that I would want to do it in. We've cooled down the weekly timeframes. We've really cooled down the daily timeframes. And we've also cooled down the monthly timeframes as well, going for the ever so frequent back test of the, well, not so frequent, but, oftentimes companies, when they run a ton, right, they can come back down and back test this one. The only problem that I've had with this company for a while is the amount of debt that they have, right? They say they'll outgrow it, but it's kind of a black cloud above this company right now. Forward multiples for 2026, finally. When we did their earnings after here, I was saying it's pretty expensive right now as a stock. At 240 now, though, now it's more manageable. 1.76 PEG and a 30 forward multiple for some pretty good revenue and EPS growth rates overall. Those are most of the plays that I'm kind of looking at from the ones that were kind of down today. Obviously, when we ran through the indexes, I gave you guys more ideas, right? Financials stuff that I was looking at, some energy plays I was looking at. For names that are currently on the top here today, Expedia is kind of out of the question for me. I'd rather buy maybe Booking.com. Down here at these great valuations, which we covered last week after earnings, or Airbnb as well, which we did cover too after earnings, both in a nice fundamental area for valuation, but also in a nice area of support. So I won't be doing Expedia, but I will probably be playing those other two companies. Affirm, solid company, strong earnings. We cover them. Very nice support area. I'll be continuously playing some short puts on Affirm down here, but also not the worst opportunity if we're looking to possibly go long and follow this company's fundamental expansion story over the next few years. If you haven't seen my earnings breakdown, make sure to go check it out, the one that I did last week. A few people keep asking me about DraftKings. DraftKings is a tough play because it's a sin stock and because the regulations kind of get to them, right? They try to get approvals. Sometimes their approvals to be licensed in certain states and get disallowed type of thing, right? But at 37 is the last time I did the valuation. Down here at 30, it makes sense for a bid. If this is a company that you like, we're in multi-year areas of support right now. They are growing the business fairly well. We are talking about a company that is now starting to be on its way to positive net margins. It's still a little bit, inconsistent right now, but we do have nice EPS growth coming into positive territory for the next few years and still consistent, nice revenue growth as well. DraftKings is not too expensive. It's a $15 billion market cap that next year will be making about half its market cap in revenue. And as I said, it's on to the story of profitability soon. So it could be a nice opportunity down here now that we are, daily oversold conditions as well, and after their earnings release too. Moving on further, BMNR is a play that I like a lot. I'll be playing it down here, accumulating some longer term shares, but also selling put options and just playing the volatility on this one. Still one of my favorite ETH proxies. So looking forward to playing this one in the low 40s to possibly 30s as well. Not a bad time to be adding some shares if you do enjoy this company. Oscar Health had their earnings last week. Maybe we can cover them coming into this week. And they had pretty good earnings, not going to lie. They did a good job of pulling back from the highs to some of your more recent support areas, 18 to 17. Decent area if you are looking for a longer term position on Oscar Health for the eventual breakout out of this big range. Well, this is the area to kind of rebuild the position. You might remember I bought some calls here, sold them there. I might just be looking to get back in for some 2027 leaps type of thing, right? Because now the valuation, it does make sense. And we're getting closer to 2026 when all of these companies will have better Medicare advantaged rates. Now that we're in here, short puts below the lows or some leap call options, not the worst, or even just some shares if you guys just wanted to buy some shares. And maybe another one we could talk about really quickly is Reddit. We covered Reddit after their earnings. I was saying after earnings that if you get a test down here, 175 to 160, nice location for some shares. It is a weekly downtrend right now. We got a pretty big move down there, but a huge bounce coming out of Friday. They tested almost their 200-day EMA and the confines of support right now. Still a very decent area to add, even in the high 190s, because we did the valuation at 214 after earnings. And we said, you know, with these revenue and EPS growth rates, and these advertising growth rates as well, and these huge margins, the valuation makes sense, especially if you're trying to hold it for a multi-year play. So Reddit, still one of my favorite opportunities because of the volatility to sell put options below here. But even for some longer duration shares, for some swing trades, not too bad at all. And maybe one last one, a fan favorite, Rocket Lab. If you were looking to maybe buy some Rocket Lab, if you have the thesis that it's going to be the mini SpaceX, they have a very solid management team. The valuation doesn't really make too much sense at the current stage. $25 billion company. They're not margin profitable at all as they're continuing to scale their operations right now. But sometime in 2027, they should be coming into positive EPS. And the revenue scale is quite attractive. That being said, the company's not cheap. So this is kind of a technical trade looking for a bounce, yeah? Stop loss can go below support right now, below 46, and you would just be looking for the longer form re-expansion of this weekly time frame, but also the monthly as well. Looking for a bit of recapture right there. Nice backtest though in this region. It's a very volatile stock, so don't be surprised if the markets are not, you know, conducive to further growth. If the S&P and QQQ unwinds, of course, this one is going to head lower for a further retrace down to 43, but selling some put options down here with the volatility and maybe even accumulating some swing trade shares if you've been patiently waiting for a pullback and a support. Not the worst opportunity if you have a multi-year thesis on this one, going for the expansion of the company's business overall. That's everything I had for you guys for the biggest gainers and losers of the day. Of course, there's many more, but we only have so much time in these videos, so hopefully you guys enjoyed some of those. I tried to include some of my favorite plays, some of the fan favorite plays, so hopefully you guys enjoyed that. Now, in terms of my portfolio, to wrap it all off, well, here are the trades that we made last week. Very small week of wheel trades for me because, as I was saying last weekend in the top 5 options video, I'll be waiting to see some oversold conditions, some spikes in the VIX, and just waiting for the markets to consolidate a bit more into their EMAs. That kind of came into us Thursday and Friday. So although we don't have that many realized profit trades on the wheel this week, I have a lot of new trades into next week that I actually opened on Thursday and Friday, which I'll show you shortly. This one, BX, you might notice we opened it for $1. I closed it for 90 cents. I wasn't willing to hold it into the end of the week because at the same time I closed it, I pivoted to NVIDIA. So I just found a higher conviction trade. There's nothing wrong with this trade, but when I was looking to just optimize my buying power and not deploy too much at the same time, I just pivoted to NVIDIA instead, right? But we had some nice wins on BITX, a little win on SOFI as well. Some of our assignments went well. We have now BITX more covered calls on our assignments. Rocket as well, more covered calls on our assignments. We got called away on Amazon. Finally, we made a nice 7.11% on that assignment over 7 weeks, which is 1% per week, which is my requirements, 0.5% to 1% per week. Ball was very strong. BMNR, I got a bit aggressive with this one coming into this week. We got assigned at 43 for 75 cents. I'll be having a lot of fun with this one on the wheel. And I did close out my little resolve trade that was a bit of a lottery position, and we lost a whole $17 on this one. Some of the assignment tracker prices, BITX, if you look at BITX right now, if you look at, well, I'll do Rocket Mortgage first. We got assigned at 18 after several covered calls and 1 DCA attempt. Our average cost is $16.39. I'll be a fan of selling more puts in the 15 range to DCA a bit more. And BITX, we got assigned this one September 26th. We've been farming the absolute heck out of it. And with all premiums received through some DCA attempts, never assigned on the DCAs, but DCA attempts and covered calls, we now have a cost basis of 41. So we're looking pretty good. I have some new covered calls at 48, which is still above my cost basis, below my assignment price, but I can always roll these higher if we move into the $48 strike. Overall, not a bad week for the wheel. We did take some lottery trades for earnings. Unfortunately, we took 2 big losses, right? One on Elf Beauty, one on CLH. And good thing I closed them when I did because they unwound even more. So I actually was able to cut these losses very quickly in the morning, which is part of the earnings strategy. But this is also why I tell you guys, never play earnings. The only losses that you guys have ever seen me take on short puts, big losses, right? Or just most, if I look back, when I told my Discord, when I took these, I said, if I look back in all these trades over the past year or so, most of the losses, I'd say 95% of all the wheel losses came from earnings trades. So what I always say on the channel, guys, is don't play earnings if you cannot cut the losses very quickly, or if you just want to avoid them altogether, just avoid them, right? I try to play them for the fun of it sometimes to generate a bit more ROI, but sometimes it just moves against us. But that's why they are, at the end of the day, lottery trades, right? They're not part of the overall wheel strategy. The wheel strategy, we're very solid, but some of the lottery trades, some of the earnings trades, they do take back. See, these earnings losses, they took back some of our profits from the week, but also some of the profits that we made in prior weeks playing earnings as well. So you can't always control where the markets goes. It's a casino. It's not every day where, you'll get 3, 4 standard deviation moves. Those are the unexpected moves, but it happens, right? Now, in terms of the positions that I have for this upcoming week, well, here it is. So if you take you guys through it top to bottom, we won't spend too much time, but just to recap, we talked about the BITX assignment. We talked about the new BMNR assignment. I'll be having a lot of fun with covered calls on this. We talked about the Rocket Mortgage assignment as well. Now, in terms of the long leap options that I still have, you might remember I have one on Bitcoin. I opened this one when Bitcoin was about 107,000. If it drops into the mid 90s, for a full retrace, I'll be adding one more call option. June 2027, 75 calls on IBIT. Sentinel-1, these are calls we've had for a while. They're still not moving. TLT, these are leaps we've had for a while. They're doing all right, I guess. They're right around break even, but we will need to have some further expansion into 2026 on these. Visa, still one of my favorite leap options in the game, just to balance some of the heavy tech positions that we have. We've now kind of just broken back even. We're slightly down on these call options, but I still enjoy the level. We opened it about a month ago, and it hasn't really done too much. It's been up, and now we're slightly down on it. XLV Healthcare, you might remember that I closed one of these call options roughly around here. XLV around the 146 level, right? And now we're just kind of holding the other one. My next take profit is the all-time highs, but still looking pretty good on the leaps right now. Nothing to report. In terms of the new wheel plays, Airbnb, that was one that I was looking for last week. We got it 112 puts for this Friday. We wrote that one on last Friday, and now we're over 50% profit. So this should be a nice win. BITX is just covered calls on assignments. CP, you might remember this was one of my value plays. Once again, balancing some of the fast growing tech names that I have in the portfolio. CP, $70 puts, very, very easy trade in my opinion here, guys. It was on the top 5 for a few last weeks running, right? Very attractive support level, bit of a defensive name, right? And now we finally got a very nice bounce out of oversold conditions. And now we might be looking to move a bit higher. So I have these were 3-week contracts. We got about 1.5% for them. And now we're looking pretty good. We're up a little bit. HIMS, I took these November 21st, $30 put options. They're not paying the best, but I gave myself some good distance. I'm not opposed to playing these a little bit closer, but I was fairly risk off when the market was dropping heavy on Friday morning. IREN as well. We got the $40 puts. Look at the distance on this for next Friday. $40 for 0.5% for 20 cents. Now, I just did this as a pure volatility trade to be safe, but we have some bounces. We have a bit more market breadth that came into the end of the day. Keep in mind, I did all these contracts when the market was bright red, like bottom of the day on Friday morning, bright red, right? Iris Energy, I will probably step this up to start playing it in the 50s and get a bit more premium, and I'll be a bit more aggressive into Iris Energy moving forward. NVIDIA, we got these 175 puts last week as well. Not on Friday, but on, I believe, the Wednesday session when NVIDIA was coming down hard. We got the 175 contracts. We got $1.24 for them. We should be safe on these, but we'll see what happens. I don't mind assignment. Rocket, just covered calls on assigned shares. And SOFI, a brand new trade that we also found on the Friday session, or Thursday session rather, 25 puts, same strike I've been playing for weeks and weeks and weeks. And we got these for about 23 cents, so almost a 1% trade for SOFI. I wouldn't be opposed to stepping up the contract size on SOFI because I do enjoy that level and the bulls have been holding it well. Then we just have a whole bunch of these positions that you guys have seen now for weeks and possibly months, right? Adobe, this was a small little swing trade that we started a few weeks ago. It's currently down. We're still trying to play the lows on Adobe. We'll see what happens. I have until February for that call debit spread. AMD is a leap call debit spread that we bought when the price was around 160. Looking good on that. We have until December 2027. Amazon, December 2027 leaps. I also have another leap position on Amazon in a separate portfolio. Straight leap call options, 205s. To be specific, for June 2027. So these AMD leaps are doing these Amazon leaps are doing what they should. CRM, another swing trade, trying to play the software recovery right here. It's currently down a lot, 43%, but we have until February to see if that one's actually going to happen. CoreWeave, we've given back all the profits. You might remember this contract was up 50%. A good thing I have until December 2027 for that contract to kind of do its thing. Maybe I'll add one more down here now that it's kind of given it all back. JP Morgan, this is another little swing trade. We have until January, 315, 320 call debit spread. We're up right now. We'll see what happens. I'll take profit into the strikes. Meta, we also had one Meta trade coming into earnings. Unfortunately, it's unwound. This will probably, unless Meta has a crazy bounce, it will probably result in a loss. I'm not opposed to DCAing it. I was waiting for a daily uptrend recapture to DCA, but we'll see what happens. Rubrik, these are leap call contract or leap debit spreads, 77 to 140. I've been talking about Rubrik for a while, guys. I still think that this is a nice area for this cybersecurity name to be kind of positioning. It's a beautiful monthly retrace, very high growth rates. And I'm just looking for, I built a bit of the position here. If we come down deeper, I'll buy one more and then I'm set. And I'll try to ride it into 2027 for that expansion. Good business overall. Small resolve lottery play, just some call debit spreads for May. We'll see what happens. And SPGI, a trade that I built around the lows of SPGI that we were highlighting on the channel. We're now break even because we've been in this one for a month. So we've burned a little bit of time, but we have until January. And that's it, man. I have a whole bunch of buying power, a whole bunch of buying power in the account leading into next week. So I'm very excited to keep benefiting from these dips. My portfolio was very well positioned into those drops, guys. I was holding so much cash, like 40% plus buying power. I deployed a little bit into the end of the week, but now I have so much more into next week as well. So looking forward to participating in the dips that the market can bring us. That's everything I had for you guys today. So I try to keep the video a bit shorter than the ones I've been recently doing, and they will be a bit shorter moving forward as we wind down earnings season. You guys know when I don't have 3-4 earnings to cover, the videos are usually between like 40 minutes and an hour. I know they're still long, but I appreciate you guys for being here. That being said, if you enjoyed today's video, consider dropping a like. Consider subscribing to the channel if you're new. We'd love to have you back. And last but not least, if you have any questions or comments or feedback, feel free to leave them down below in the comment section. You guys know I always answer every single comment, so I'm looking forward to hearing what you guys have to say. And lastly but not least, in the event that you guys were tired of trading the markets on your own and wanted to do so within a group of traders and investors such as yourself with over 300 members in there right now, you might consider joining our trading community. The link to our community is down below in the video description. In the community, you get access to all of my trades in real time, whether it's the wheel trades, the leap trades, the directional trades, my long-term portfolio buys. You get access to all of them in real time. Here's just a lot of the trades that we've been making over the past few months. The green little check marks are wins. The red little circles are losses. Obviously, the goal is to have many more wins than losses and for the wins to be much bigger than the losses. And we've been doing a good job of that over the last 2 years that I've been showing you guys these trades publicly on the channel, right? Moving on, you also get access to our private morning live streams every Monday to Friday. I trade live first thing at the open, and then I take all your guys' questions on your stocks, your options, and your portfolios. It's a great place to ask me questions directly. I can help you out with the charts, the options chains, the fundamentals, the technicals, any questions you have. It's a great place to interact with me 2-3 hours every morning. If you can't be there, they're recorded. And thereafter, you can also ask me all your questions in our chat rooms throughout the day. And I'm very fast to answer and help you out, whatever you might want to ask me. And last but not least, you also get access to our private video section, a very solid section, almost 15 hours of content in there on different trading strategies, leaps, spreads, right? Different wheel strategies as well. Every strategy that you see me trade on the channel, educational portion of it is in that section. Videos on technical analysis, fundamental analysis, how to build a long-term portfolio, how to build a trading account, right? And best practices for managing wins, losses, a whole bunch of educational content that I won't put on YouTube is there. Our members find really good value in that education section. And last but not least, you do get access to all of my charts in real time. So if you enjoy my support resistance levels that I derive on the charts, if you enjoy my fundamental breakdowns on hundreds of companies that I just put the fundamentals here, and you just want to you don't want to do it on your own, you just want to copy paste all my watch lists and all my charts, you can do that. All of our Discord members have access to all my charts. Super easy to do, takes 15-20 seconds, and they all become yours. So if any of that interests you, the link to join us in the community is down in the video description. Hopefully I get to see a few more of you guys in there soon. And if not, I'll see you right back here on the channel. That's it for me. Enjoy the rest of your Sunday. I'll see you guys today for the top 5 options video as well. And let's have another good week ahead of us, shall we? Take care, guys. Peace.